Welcome everyone to Vested Interest. This is Shane, and in this video we are going to cover my favorite topic, the dividends received for the previous month. The previous month was January. So we are going to cover all the dividends, the companies that paid out dividends in January in my portfolio. Hopefully you are having a great weekend. Let's jump right into the video. So as you can see here, total dividends received $262.44 paid out in January, and the companies that paid those dividends out started out on January the 3rd. Huntington Bankshares, ticker HBAN, is out of the financial sector. They paid out $27.34. Wednesday, January 4th, HP Inc., ticker HP, paid out $28.27. HP is out of the information technology sector. Jumping to the next week, on January 12th, ticker MPW, that's Medical Properties. This is a REIT out of the real estate sector. They paid out $59.16. We had two companies pay out on Friday the 13th. Leggett and Platt, ticker LEG, out of the consumer discretionary sector, paid out $64.61. Realty Income, ticker O, they paid out $26.26. This is a monthly paying REIT, so we will see them in every monthly update this year and every year really. So a monthly payer if you're looking for one. Realty Income, again, $26.26. Owens Corning, ticker OC. This is out of the industrial sector. They paid out $4.16. Relatively new position. I would really like to, build this one out, but they have really run up over the last couple weeks. A lot of companies have actually. So a lot of green in the market here the last couple weeks, at least this week in general, and most of January for that matter. So I know a lot of these companies have run up, and I'm looking for a pullback. I'm hoping for a pullback. So again, out of the industrial sector, $4.16 on the 19th of January. And the last company to pay out in January was on the 25th, Cisco Systems, ticker CSCO. They paid out $52.64. They are also out of the information technology sector. So all told, $262.44 paid out in January. Very nice to see that. Pure passive income. Didn't have to do anything for this money here. I do have the drip set on, so they are all reinvested. All these funds are reinvested back into these companies as they pay out. But if I was to turn that off, I would be able to take this $262.44 and use it for, bills if I wanted, groceries, go out and have fun, whatever. So pure passive income provided by the companies in the portfolio. Don't have to do anything for this. It continues to roll in month after month, quarter after quarter. Depending on the month, obviously different companies pay out. We'll see that here in a moment, but this is what the portfolio is all about. This is what dividend growth investing is all about, the passive income provided by the portfolio. And here's where we will track overall throughout the whole year. I'll slide this over there so we can see that, but we will see this every month. I will put this together and we'll do a running total, how much dividends I've been paid. I've also got it broken down here, color coded, so you can see January pays out again in April, July, October. February's payout will pay out again in May, August, and November. And then April's payout will pay out again in July and October. And then obviously companies like Realty Income, ticker O there, that pays out every month will be part of all of this. So running total so far, since we're only in February and only January has paid out, $262.44. Now here I wanted to show you how I kind of track growth year over year, month over month. So as you can see here, 3 years ago, I didn't have anything in dividends. I hadn't started the portfolio yet. Actually, 3 years ago, I did start the portfolio in March. So we're coming up in March will be this will be the second year I've had this portfolio here, and you'll be able to see that clearly growing. But last year in January, right, not quite 2 years in, was $112.73, and then here's that $262.44 that we just saw. So you can see that it's more than doubled from last year, and that's for a couple reasons. It's the funds that I've added to the portfolio over the last year since that payout, as well as the dividends paid out from those companies rolling back in, and this is the snowball effect in work here, right? So you can see that growth over time, and that's what I'm trying to show here. And then this one, I wanted to actually show you all the positions in my portfolio. So this is a snapshot from the Excel file, how I track my overall portfolio. So what you can see here is all the positions in the portfolio, the ticker there. So Ally, is out of the financial sector. BAC is Bank of America, another one out of the financial sector. There's Cisco that we saw paid out there. CSCO, that's out of the information technology sector. Enbridge is out of the energy sector. EPD is Enterprise Product Partners, that's out of the energy sector. HBAN is Huntington Bankshares, ticker HBAN. They paid out in January as well, right? HP we saw paid out in January. Intel, Johnson & Johnson, Kraft Heinz, Leggett & Platt, they paid out in January. LyondellBasell, Medical Properties, they paid out. Ticker O, they paid out. Owens Corning, they paid out. Omega Healthcare Investors, Procter & Gamble, Prudential, SBSW, Siboney-Stillwater, this is a mining company. Stanley Black & Decker, SWK, T for AT&T, Union Pacific, Vale, Verizon, and Whirlpool. So those are all the positions here. Then we'll run across the top of here, total shares, so you'll see how many shares I have in each position. The current price as of the close of business Friday, this was the current stock price for each one of these positions. The market value, so that's what it's actually worth, 85 times 34.76, that's what you get there. Average share price, that's my cost basis. So what I've paid for these 85 shares, right? Purchase price, so basically it's 85 shares times my cost basis is the purchase price. My total return right here, so whether I'm up or down, if it's in the red, you can see that. I've got it highlighted in red, all the positions that are down. Percent return, whether I'm positive is green, red means I'm down, negative, right? And the greener it is, obviously the higher it up, right? 31.77%, I'm up in Ally, Enbridge, a lot of positions up now. Only 1, 2, 3, 4, 5, 6 positions currently down. Verizon's barely down, it's really come back. 9.23, I think I was down 19% at one time in Verizon. Right, so a lot of these positions, J&J is down a little bit. I wouldn't mind adding and building this out, trying to get 100 shares here. Right, the sector that they're in, whether it's a quarterly, monthly, or dividend payer, and then the amount that they pay out. So 30 cents paid out by Ally quarterly, 22 cents Bank of America, and I update these as they update. Right, I have one monthly payer, which is O, Realty Income. I have a couple of semi-annuals. They're both mining companies, SBSW, Siboney-Stillwater, and Vale. Semi-annual, the current yield, right, and my yield on cost. So this is based on my cost basis, and you'll notice here 4.911% yield, current yield, and my yield on cost is higher than the current yield, and that's the way it should be, right? I want these to go up over time, and I want my yield on cost to go up and be more than what the current yield is. That's way. And then you'll see your portfolio weighting. So that just basically means what percentage of the portfolio is allocated to Ally, Bank of America. You know, you can pause this and go through these at your leisure. Estimated annual dividend income. So each one of them, $102 will be paid out by Ally, $181 by Bank of America, so on and so forth. Payout months, what months they pay out. And this is another category I like to include is dividend growth. So I can see, and this will change over time, right? Just because Ally Bank is currently growing at 36.36% does not necessarily mean it will stay that way. And I will adjust all these numbers over time as they change, right? So I try to get in here once a week before I do my portfolio updates. I update this, so I figured I would include it in my, I may add it to my portfolio updates as well as this monthly dividend payout. And then what you'll see up here is the combined yield. So what I've done there is I've taken the yield on cost, 5.114%, and the percent return, 4.12%. So that is the combined yield, those two numbers, what the portfolio is returning me in both in stock appreciation from the price going up or down, as well as the dividend yield on cost paid out. So this would be right in line with an ETF, right? Returning 9.234%, pretty much in line with the overall market. If you were to buy like an S&P index fund or something like that, right around 9 to 10% is what you should expect to return. So I basically built out my own ETF here. All these positions are my ETF. And these dividend weights change over time, right? I try to keep everything, nothing too weighted too heavily. Some of them do get a little over where I'd like them. I'd like them all around, 3, 4, 5, 6%, right in that range. A couple of them 8%, I think 7% there. But some of that has to do with like LyondellBasell here. Well, it's up 11.83%. So that's part of the reason. And I'm not going to sell some of it just to bring it down in line with a 6% allocation mark, right? I'll just stop adding to it and add to other positions in the portfolio, and eventually that will work itself out. So there's no rhyme or reason for the portfolio weighting, but I do like to try to keep it pretty distributed evenly across these. Like I said, if something gets up to 6, 7, 8%, I'm not going to freak out. Some of these are lower because they're smaller positions, right? Union Pacific, I'd obviously like to build that one out. Stanley Black and Decker is another one, only 10 shares. I'd like to build that out. J&J, I'd like to build this out, even though it's already 7.74% of the portfolio. I would not mind building this to 100 shares and then backing off, right, and letting it remain there. So it would be overweight in the portfolio maybe for a while, but then level out over time. Same thing, Bank of America. I don't mind that being a 6.32% of the portfolio. It's growing at 13.33%. I want to build out Ally further. So some of these are pretty well built out positions. Other ones I want to continue to add to whenever they present value. Owens and Corning, only 20 shares there. That's another one I'd really like to add to. Plus it is growing, right, at 34%. So trying to grow out some of these faster growers too. And as you can see, there's a pretty good mix here between fast growing and slow growing, right? Some of these positions are not growing as fast as others, 2.72%, but it has a decent dividend yield, 3.02%. 2.3% yield on cost, growing at 13.3%. Got a 4.5% yield on cost on Ally. It's growing at 36%. That's very nice. So yield and cost. So again, you can pause this, kind of look at it. I'm not recommending you buy or hold any of these shares. So let's get that out there. You buy based on your investing criteria. These meet my investing criteria, right? So I've got some fast growers. I've got some slower growers with higher yield. I've got some very high dividend yielders in here. Let's look at that real quick, right? So you've got one right here at 9%. That's Enbridge. So that's a higher yield. Enterprise Product Partners. That's a 9% yield on cost, or 8% yield on cost. That's a higher yielder. 10.86, right? That one's Medical Properties. That's a trust, or a REIT, Medical Properties Trust right there. Another one is OHI. Where's that one? Omega Healthcare. I think that one's 8.8 right there. Another REIT, 9.4%. Even Valet, higher yielder, 10.25. Verizon is actually a higher current yield at 6.29 than it is yield on cost at 5.7, but another higher yield. Whirlpool, same thing, 4.9, but it's jumped up in price back to 154. I'd like to get it back in this 140 or 130 range. So a lot of stocks have run up this past week, this past month, really. And I just want to talk about that just for a minute before we wrap this one up. In my opinion, a lot of people have gotten wrong what the Fed said this past week, right? They did raise rates again by 0.25%, so we are right around 4.5% Fed rate. Inflation is starting to come down. I think it's in the 6%, down from the high 7s. Even 8% where it hit last year. So it is starting to come down, I believe, or they even said they are going to continue raising rates. So I think we're going to see at least 2 or 3 more 0.25% increases over this year. They also said they are going to keep interest rates higher for longer to really get inflation down. Their concern is if they stop too soon raising rates, and if they reverse trend and start reducing rates, right, inflation will get out of control again. And we just saw a very strong jobs report as well. Over 500,000 jobs added to. So that's another thing. They're trying to get jobs to slow down, which will also help bring down inflation. So that's really their number one goal right now, bringing down inflation. And to do that, they're going to increase the rates. Now, normal Fed rate is between 4 to 5%, usually around 4.5, 4.3%, right in there, which would give us about a 5 to 6% like mortgage rate, interest rates, which I know everyone's freaking out because it seems high, because just a couple years ago, for example, my mortgage rate right now is 2.75%. We just redid our mortgage 2 years ago now. But when I bought my first house in 2003 in Utah while I was in the military. My mortgage rate was 6.75% after I reduced it twice. I bought my house at like 7.5, 7.6, and then I refinanced, right around 6.8, and then I refinanced again at 6.5 to lock in the lower rate. And that was considered a low interest rate at the time. Obviously, after 2008, they dropped interest rates all the way down to almost zero, which is historically low. That is not normal. I know for a lot of you who've only been investing in the market for the last, 10 years, you've seen historically low interest rates. So very good return on the overall market. A lot of people are using margin or taking out loans, dumping into the market because you could get a loan for such a cheap rate and get a better return in the market, right? And pay off the loan whenever you were done. Those days are over. The cheap money, also the money from all the stimulus package, that's not normal. That we didn't have a normal market for the last 10 years. What you're seeing now with the Fed's rate around 4.5%, that is historical average. So all we've done is gone back to historical average Fed rate and mortgage rates, right? So I believe they're going to go a little high, probably get up to maybe 6%, at least over 5%. And then that way in a year or two, I don't think they might pause rates later this year, third quarter, fourth quarter, stop raising rates altogether. Maybe they pause it, but they are not going to lower or start lowering rates again until next year. Unless something drastic happens, you're not going to see those 0% interest rates or 0.05% or 1% anytime soon, folks. That's just not normal. So I hope everyone understands that, and I'll get off my soapbox and stop rambling here. But I just wanted to touch on that a little bit because the market has really rebounded over the last month. And I believe that we are still in a downtrend. As the months go on and people realize that the Fed's going to keep that rate higher, they will readjust. And I think a lot of these companies that have run up here in the last months, 50, 60%, Ally the other day jumped up by 19% in one day. Folks, that's not sustainable, right? Even though the stocks were beaten down, jumping up 19, 20%, that shouldn't happen. So I believe there's going to be a correction, right? Ally Bank is 31.77% being up like that. I mean, that's just unrealistic. I like to see it, don't get me wrong, but it also makes it harder for me to add to these positions. So selfishly, I'm hoping that these return to a little bit of more red in the portfolio, let's say. Well, that is really it. Why don't you let me know down below what companies paid you out this month or the previous month in January? Well, tell me what companies are going to pay you out in February as well. I always love to hear from you guys. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that like or thumbs up. Share with anyone you think might find value in the content. Drop a comment down below. That really does help me out. Hit the notification bell, and most importantly, subscribe to the channel, right? I'm a small YouTube channel trying to grow here. So the more you guys like, share, comment, hit that subscribe button and the notification bell so you're notified whenever I post any new content. Go ahead and hit all of those down below. It really does help out us small YouTube channels get the word out. And that is the idea. And also, drop a comment down below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, suggestions for future topics, or constructive criticism. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you're having a great weekend. And don't forget to tune back in tomorrow, Sunday morning. I will be putting out my portfolio update so you can see what I added to my portfolio this week. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and selected criteria, or seek advice counsel with a certified financial advisor.